Welcome back to Simply Explained. Today we're going to compare two cannabis companies, Canopy Growth and Aurora Cannabis. Now, I wrote this article back in 2019 and it got a lot of traction on Reddit and it was viewed over 10,000 times. A lot has happened since then. Let's look back at the analysis we did and how we got the conclusions we did back then, but let's also look at the future of the stocks. How is the sector doing now? The basis of my analysis was to break down the profit component into smaller parts. It was to look at profit margin, how much should the company get to keep for every $100 sold, and capital turnover rate. Now, let's start by looking at the profit margin for Canopy. We do this by dividing gross margin before undernoted with the revenue. This gives us 51.5%. Now let's look at capital turnover rate. We find this number by looking at the total amount of asset that the company has on its balance sheet. And we divide the revenue with this. How many times over do the company turn over the amount of capital that they have in the business? How effective are they, in essence, with the capital that they have and manage? This is what we look at as investors in this metric. And we can see that Canopy turns over the amount of capital that they have under management about 5.4% of it. Now, why are these two numbers interesting? Well, if you multiply them by each other, we get profit. Let's look at what an investment would have yielded in terms of profit back then. By multiplying, we see that investing in Canopy will generate a return on investment of approximately 2.8%. Not very good, right? Let's look at the stock price of Canopy back in March. Quite high. Very highly valued. And all good things must come to an end. If slow regulation doesn't provide the growth that the market was expecting, we can also see share prices dip here. Now, when the market prices in growth, purely mathematically, it's a subtraction on the denominator part of the division. So it means it gives bigger stock price when you believe higher growth. But that's a formula for another day. Let's look at Aurora Cannabis. Same procedure here. Here's a takeout of the balance sheet I used back then. We did the analysis once again, same procedure. You can pause and read if you want to. And we could see a return on investment of approximately 1.9%. So not as good as Canopy. We can also see the stock price here. Now let's think logically. Are these findings reasonable? Well, Aurora grew a lot by acquiring other companies and offering their own stocks in the merger. They acquired a lot of assets very fast. and we can also see this by the low capital turnover rate. But a lot of assets under management generally means you can have a higher margin. Just look at two other examples. Let's say you run a water power plant. Costs a lot of money to invest, build, manage. There's a lot of capital under management, but you have a high profit margin. And compare that with your local grocery store. The wares are hopefully just flying off the shelves, but margins are low. So we can see that this holds true out in society. And we can see that from an ROI perspective, Canopy was the better investment. Now, what I see here today, if we look at the stock prices, is that the market has deflated them. And what this tells me is that maybe they don't look as favorably upon growth prospects now as they did back then in the legalization hype. So back then, I was very much opposed to investing in weed stocks and cannabis. But now, I think that the evaluations are fair again, and that the pendulum has swung back. And I personally bought some shares in Aurora. This is going to be very exciting to follow along and see what's happening in the future. Thank you for listening in, and hopefully you found this to be insightful.